Welcome back to the deep dive. Today, we're really taking on, well, a true heavyweight of legislation. We're diving deep into the massive overhaul of Nigeria's tax system, specifically the new Nigeria Tax Act 2025 and the Nigeria Tax Administration Act 2025. And this isn't just, an update. It feels more like a foundational rewrite.
Oh, absolutely. It's a complete structural reset. And that's really why it's so crucial for you to understand this. We're not talking about small tweaks here. This new framework, it consolidates and, well, effectively repeals decades of foundational laws. Things like the Capital Gains Tax Act, the Companies Income Tax Act, Personal Income Tax Act, even the entire old Petroleum Profits Tax Act. Gone.
Wow.
Yeah, think of it like clearing out a huge chunk of the legal library and replacing it with this single unified system. That scale alone tells you a lot about the compliance shift that's coming.
Absolutely. Okay, so let's try and unpack this straight away. When you wipe the slate clean like that, what's the fundamental, maybe philosophical change in how income is now viewed for, say, the average Nigerian company or resident individual? Is it still about where the money actually lands?
Well, the primary shift is really about crystal clarity on worldwide income. For Nigerian companies and individuals who are defined as residents, the law makes it absolutely explicit now. They are taxed on their income, their profits or gains, wherever in the world that income pops up. Wherever. And crucially, it doesn't matter whether or not that income has actually been, repatriated, brought into, or received in Nigeria. The tax net is now definitively global for residents.
Okay, that definitely sets the stage. But here's where it seems to step into, like, the global big leagues, tackling that challenge of international tax avoidance. This legislation introduces a concept, I think, designed to enforce a minimum effective tax rate. What's this floor, and which companies are really in the crosshairs here?
Yeah, this is a direct response, really, to the global movement towards the OECD's Pillar 2 ideas. The new law sets up a minimum effective tax rate. It's 15%. And this applies to two main groups. First, constituent entities of a multinational enterprise group and M&E groups. We're talking the biggest global corporations. And second, any company, even domestic, with an aggregate turnover of N20 billion naira or more. It's a pretty high threshold.
Okay, and 20 billion. So if you're one of these massive international or domestic companies, and maybe your clever accounting gets your effective tax rate below that 15%, what happens then?
Well, simply put, you have to pay an additional tax. It's specifically designed to bring your rate exactly up to that 15% threshold. This isn't optional. It's a mandated floor. The main goal here seems to be increasing revenue certainty for the government and, aligning Nigeria with these emerging global minimum tax standards, making sure that large profitable outfits pay what's seen as a globally acceptable baseline rate.
Right, a powerful floor for those big players. Okay, we've sort of covered the foundations. Let's talk about where, the rubber meets the road for modern business, the digital economy. The world's moving beyond just physical offices, right? So how does the NTA make sure non-residents operating digitally in Nigeria still, well, pay their share?
Yeah, historically, tax jurisdiction really depended on, bricks and mortar having a permanent establishment. The law has now quite decisively, I'd say, moved into the 21st century by expanding that definition. Non-resident profits are chargeable to tax if that entity has what's called a significant economic presence, or SEP in Nigeria.
SEPI. Okay, that sounds like one of those crucial acronyms that you, our listener, really need to get your head around. Why does SP matter so much? What's it trying to achieve?
Well, SEP is basically the legislative answer to taxing the global tech giants. Think, Google, Amazon, major streaming services, companies that make huge revenues from Nigerian consumers, but might not have a physical office or payroll here. It means your economic engagement, just that engagement alone, can create a taxable presence.
Okay, but I can imagine in the digital world, figuring out the actual profit that comes from Nigeria must be incredibly complex sometimes. Did the legislature put in some kind of mechanism to stop, messy, long arguments over profit allocation?
They did. They installed a pretty strong backstop, actually.
Sure.
If the tax authority can't readily figure out the total profits linked to that significant economic presence, or maybe if the profits they do figure out seem suspiciously low, then the tax calculation just defaults to 4% of the total income generated from Nigeria.
4% of total income.
Yeah, it ensures the tax base is protected. It guarantees, a minimum revenue stream from those digital activities, even if profit calculation gets tricky.
And are there special rules for sectors that are just inherently international, like transport, dealing constantly with goods and passengers coming in and out?
Yes, definitely. There are specific rules for non-resident shipping or air transport companies. They get taxed based on carrying passengers or goods loaded in Nigeria. And the law specifies that the tax payable by these companies must not be less than 2% of their gross revenue from that specific carriage. So again, it's a floor. It's designed to ensure a minimum contribution from these high-volume international activities.
Okay, let's pivot now to something I know a lot of people are curious about. Digital assets, the crypto world. What does this virtual asset service provider framework, ASP, I think it is, what does it mandate?
Yeah.
And which transactions are now squarely, on the tax table?
Right. The fifth schedule of the new act creates a pretty comprehensive framework for these VASPs. So if you're involved in, say, exchange, trading, custody, or even issuance of virtual assets,
Mm-hmm.
you have to register. And you need to get a license, often from the SEC, especially if the assets count as securities. And the list of taxable transactions, it's broad. It captures basically all income-generating activity. So not just the obvious stuff like selling or exchanging virtual assets, but also income you get from mining or staking activities, even assets you receive as airdrops or bounties.
Airdrops and bounties, too. Okay, so what if a company gets paid in, say, a token, a virtual asset, instead of Naira for a service they provided? How do they figure out the taxable value? Because that volatility must be a nightmare.
You've absolutely hit on the most critical practical point there. If virtual assets are used to pay for goods or services, they get the exact same tax treatment as fiat currency, like Naira, but they have to be valued at the prevailing market price at the exact time the transaction happens.
At the time of transaction, wow.
Yes, this rule is key. It forces businesses to constantly accurately calculate capital gains or losses or just the value of income they've realized right at the moment of exchange. It ties tax liability directly to that asset's volatility, which, as you said, can be intense.
That definitely creates huge compliance complexity, but I suppose also much needed clarity on the government's position. Okay, let's shift gears now to specialized sectors, starting with the real heavy hitters of the economy, upstream petroleum operations. What seems fascinating here is this introduction of a dual tax system and also a hard limit on deducting costs.
That's right. The new system makes profits from upstream operations subject to both the new hydrocarbon tax and income tax. But the major guardrail, and this really fundamentally shifts the economics of investment, is something called the cost-price ratio limit, the CPR limit.
CPR limit. Okay, what does that limit actually mean in practical terms for, say, an oil company?
It means that the costs they can claim for hydrocarbon tax deduction, well, they're capped. They're subject to a maximum limit of 65% of the gross revenues. So you simply can't deduct more than about 2/3 of your revenue as costs when calculating this specific tax.
65% cap.
Yeah. And this isn't just some accounting rule, right? This is a policy decision. It significantly impacts the risk-reward calculation for new exploration and production investments. It basically ensures a minimum level of taxable profit, no matter how, let's say, aggressive the cost recovery efforts might be.
That's definitely the stick then. Let's maybe look at the carrot side for a moment. Economic development tax incentives. This legislation outlines specific priority sectors. What does a company actually have to do to qualify for one of these tax holidays?
Well, these incentives, they're governed by the 10th schedule, and they require pretty substantial commitment. It's not easy. To get an economic development incentive certificate, a company has to show significant qualifying capital expenditure, or QCE. And the threshold is quite high. It varies depending on the sector.
Can you give us a sense of the scale? What kind of investment are we talking about here?
Sure. Let's take two examples. If you're building, say, a tertiary or specialist hospital, the minimum QCE needed is N5 billion. That gets you a 20-year tax sunset period. But if you're looking at large-scale manufacturing like motor vehicles and their components, that qualifying capital expenditure threshold jumps way up N50 billion. And that grants a 15-year sunset.
$50 billion, okay.
Yeah. So the law is clearly designed to channel really monumental capital into specific targeted development goals.
And that tax holiday, it isn't just open-ended, right? What happens if the company is, wildly successful during that period? Can they extend the incentive?
They can, potentially, but the conditions are very strict, very prescriptive. The incentive period can be extended, but only by a maximum of 5 extra years. And that's only if the company reinvests 100%, all of it, of the profits it earned during the initial incentive period, right back into expanding the production of the same priority products or services.
So it's an incentive to grow, not just sort of bank the profits tax-free.
Exactly. Grow within that priority area.
Okay, let's turn now to maybe more practical compliance stuff for everyone listening, VAT and stamp duties. The VAT rate itself, that hasn't changed, has it?
No, that's correct. The rate stays at 7.5%. However, the law does provide some welcome clarity on essential exemptions, which is helpful. This includes specific baby products, locally manufactured sanitary towels and tampons, that's important medical services, and also tuition fees for standard education levels,
Yep.
nursery, primary, secondary, and tertiary. Helps ensure those basic necessities remain accessible, hopefully.
And what about the admin side of VAT? Any changes there?
Yeah, compliance is definitely tightened around the documentation. Taxable persons must issue a VAT invoice, and it has to contain specific details, the supplier's tax ID number, the gross amount of the transaction, and, of course, the rate and amount of VAT charged. And importantly, the Service the Tax Authority now has the power to mandate the use of electronic invoices for this. So moving towards modernizing that whole record-keeping process.
Right, e-invoicing. Okay. Moving on to stamp duties then. What kinds of transactions are considered dutiable under this new structure, and how has the system adapted to, the age of constant electronic funds
Okay,
transfers?
stamp duties are levied on specific things called dutiable instruments. You think conveyance on sale, duty on share capital, loan capital, and also leases. Although for leases, it only kicks in if the annual value is N10 million or higher. The law has also, thankfully, modernized how you actually pay stamp duties. It allows for digital methods now, like electronic tagging or electronic receipts, not just physical stamps.
Is there any relief for just the sheer volume of tiny digital transactions we all do every day?
Yes, thankfully there is. There's a key exemption built in. Electronic transfers that are below N10,000 are exempt. Also, salary payments are exempt. And intrabank self-transfers, moving money between your own accounts at the same bank, those are exempt too. So that provides, real relief for small daily transactions.
Good to know. We probably need to wrap up the compliance segment by stressing the consequences, though. These admin requirements, they come with some pretty severe penalties, don't they? For instance, if a company just fails to deduct or withhold tax when they were supposed to, what kind of penalty are they actually looking at?
Oh, the penalties are steep.
Yeah.
Very steep. And clearly intended to change behavior. For just failing to keep the required accounts or records, the penalty for a company is N50,000. Okay, not huge, but noticeable. But the penalties for actual tax delinquency, much, much more serious. If a person, company, or individual fails to deduct or withhold tax where they were required to by law, they face a staggering administrative penalty of 40% of the amount they failed to deduct.
40%. Wow. That penalty feels almost punitive. For a large company, that level of financial risk could completely change how they assess compliance risk, couldn't it? Is the goal there purely just collecting revenue? Or is it really intended to force absolute adherence to those withholding rules?
I think it's clearly aimed at compelling adherence. Absolutely. The legislature seems to understand that withholding agents, employers, companies making certain payments, they're effectively acting as delegated tax collectors for the government. So by setting that penalty at such a high level, 40%, they're making the financial cost of getting it wrong or not doing it so incredibly high that it really incentivizes rigorous, proactive adherence across all businesses, ensures the government gets its revenue immediately, right at the source.
Okay. But what if a company is facing a genuinely new situation or a really complex transaction where the rules aren't immediately obvious? Is there any formal way to get clarification before they potentially make a 40% mistake?
Yes, there is a mechanism. It's the advanced ruling process. A taxpayer can actually request a formal ruling from the relevant tax authority on a specific planned transaction or a particular issue before they go ahead with it. However, and this is a big however, you need to know that this ruling is very narrowly defined. It's limited only to the applicant who requested it and only for that specific transaction they asked about. It can't be used as a general precedent by anyone else, you see.
Right, okay. Specific and non-transferable. Understood. This has been a genuinely illuminating tour of what sounds like a monumental piece of legislative restructuring. To quickly summarize the core themes we've hit for you, we've seen this powerful consolidation effort, rapid adaptation to the digital economy, things like SETP and the VAST rules. There's the enforcement of that clear 15% effective tax rate floor for the big global players, and then these strong incentives, but balanced by really stringent compliance measures and, well, penalties designed to change behavior.
Yeah, if you sort of connect this to the bigger picture, this whole move reflects a pretty sophisticated effort, I think, to modernize Nigeria's tax base, to provide revenue certainty, especially through those clearer non-resident rules and that minimum tax floor, and also to streamline compliance under a single unified administration act. Now, while the sheer volume of change is frankly daunting, the ultimate goal seems to be structure, fairness, and hopefully certainty for doing business in the 21st century.
Which brings us perfectly to our final thought for you to maybe mull over after this. Given that highly detailed definition of taxable virtual asset transactions, including income from mining and airdrops, remember, and that new requirement that any virtual asset used for payment has to be valued at the prevailing market price. What specific, maybe high frequency business to business transactions that currently use quite volatile virtual assets? What kind of unexpected valuation headaches and admin complexity might they now face because of those constant market fluctuations, even if they aren't your typical VASP exchange? Something to think about. That's the end of this deep dive. We really hope this gave you the strategic shortcut you needed to start grasping the huge implications of Nigeria's new tax framework.